All right, what's up everybody and welcome back to the channel. So NVIDIA IDEA just dropped their Q2 earnings, and on the surface, it's another absolute banger. Revenue up, EPS up, another beat for the king of AI. Jensen Huang and the team are basically printing money over there. So why did the stock take a nosedive in after hours trading? That's the million-dollar question, isn't it? The headlines scream beat, but the market whispered meh. This is one of those moments that separates the casuals from the players. It's a paradox that tells you everything you need to know about the state of this AI gold rush. Today, we're not just reading the press release. We're going to peel back the layers of this earnings report like an onion. We're going to look at the quality of this supposed beat. We'll pinpoint the flashing yellow lights of slowing growth. We'll map out the storm clouds gathering from China and a new army of competitors. And we'll figure out what a truly gobsmacking $60 billion buyback really means. This isn't just about one quarter. This is about whether the greatest growth story of our lifetime is about to enter a new, much more complicated chapter. Stick around, you're not going to want to miss this. Okay, let's get the numbers out of the way. NVIDIA reported Q2 revenue of $46.7 billion, just squeaking past the consensus of about $46.5 billion. Adjusted EPS came in at $1.05, again, just a hair above the $1.02 Wall Street was looking for. Now, in any normal universe, a company posting 56% year-over-year growth is popping champagne. But NVIDIA doesn't live in a normal universe anymore. It lives in the price for perfection universe. The market's reaction tells you that Wall Street has two sets of numbers: the official consensus they publish, and the whisper number, the real number the big money was betting on. NVIDIA beat the official number, but it clearly missed the whisper number. And the smoking gun? The data center. The absolute core of this entire operation, it pulled in $41.1 billion. That sounds incredible, right? It is. But some of the sharper knives on the street were looking for as much as $41.3 billion. A tiny miss, a rounding error for most companies. But for NVIDIA, which gets almost 88% of its revenue from this single division, it's like the star quarterback fumbling on the 1-yard line. It's the one thing that had to be perfect, and it wasn't. That right there was the catalyst for the after-hours sell-off. But it gets deeper. Let's talk about the quality of these earnings. Buried in the report was a little nugget that $1.05 EPS number got a boost from a one-time release of $180 million in previously reserved inventory. They sold off a batch of their restricted H20 chips to a non-Chinese customer. Think of it this way. It's like you telling your spouse you hit your savings goal for the month, but failing to mention it's because you found a $100 bill in an old coat. It's nice, but it's not repeatable income. The market sees right through that. When your main engine, the data center, underwhelms and you only make your numbers because of an accounting gimmick, the narrative shifts from strength to potential weakness. It shows just how sensitive, how neurotic the market is at these valuations. Flaws are no longer tolerated, they are punished. Now, let's zoom in on that data center growth. Yes, 56% year over year is still God tier. But here's the number that matters more. Last quarter, that growth was 73%. That's a 17 percentage point deceleration in one quarter. This is the first real statistical proof that the first wave of the AI infrastructure build-out, that frantic buy everything at any cost explosion, is maturing. The rocket is still screaming towards orbit, but the G-forces are letting up. We're transitioning from ludicrous speed to just very, very fast. And this is precisely why the other divisions, which have been living in the data center's shadow, are suddenly more important. Gaming is back with a vengeance, up 49%. Automotive is quietly becoming a real business, up 69%. For the past 2 years, the NVIDIA story was a one-man show. Now, as the law of large numbers starts catching up to the main act, these supporting characters need to start carrying more of the weight. They're the hedge against an AI spending slowdown. Then there's the holy grail, gross margins. NVIDIA's non-GAAP gross margin was 72.7%. For a hardware company, that's just insane. That's Apple-level stuff. It's the clearest sign of their monopoly-like pricing power, but even here the pressure is building. The peak of nearly 79% is firmly in the rearview mirror. Why? 3 reasons. First, that new deal with the US government to sell chips to China comes with a 15% revenue sharing clause. That's basically a direct tax on every chip sold. Second, the new Blackwell platform is a beast of complexity, and building it with cutting-edge components like HBM3 eMemory is expensive. And third, Competition from both AMD and the cloud giants building their own chips is finally starting to introduce price pressure where none existed before. The days of charging whatever they want might be numbered. So you're hearing all this and thinking, okay, the story's cracking. Not so fast. To understand why NVIDIA is still the undisputed king, you have to look past the quarterly numbers and see their real competitive advantage. It's a two-part punch, a relentless product roadmap and an invisible software moat. First, the roadmap. We are in the age of Blackwell. Demand is so insane that the entire 2025 production run is already sold out. But here's the killer move. Just as Blackwell is starting to ship, Jensen is already on stage talking about its successor Rubin coming in 2026 and Rubin Ultra in 2027. This isn't just product development, it's a strategic weapon. Imagine you're AMD. You've just launched a chip that can kind of compete with NVIDIA's current chip. But before you can even get a foothold, NVIDIA has announced the next 2 generations. It forces customers into a corner. Do you invest in a competing product that will be obsolete in 12 months, or do you just stay inside the NVIDIA ecosystem? It freezes a part of the market, creating a built-in demand pipeline for their future products. The roadmap itself is the moat. But the real unbreakable moat, it's one word, CUDA. For anyone who doesn't know, CUDA is NVIDIA's software platform. Think of it as the iOS for AI. It's the operating system that everyone builds on. You don't just buy an NVIDIA GPU, you buy into a decade-plus ecosystem of developers, libraries, and applications. Switching isn't like swapping out a graphics card. It's like telling a lifelong iPhone user to switch to Android. You'd have to relearn everything, rebuy all your apps, and abandon the ecosystem you know. The switching costs are astronomically high. This is what people miss. NVIDIA isn't a hardware company anymore. It's a platform company. Jensen calls it an AI factory. The GPUs are the machines, CUDA is the operating system, and their AI enterprise software is the application suite. They capture value at every single layer of the stack. A faster chip from a competitor is a threat, but the only thing that can truly kill NVIDIA is a viable open source alternative to CUDA, and right now nothing even comes close. Okay, now for the messy part. The geopolitical battlefield and the competitive landscape. NVIDIA is fighting a war on 2 fronts. First, the China saga. This has been a complete soap opera. To recap, NVIDIA makes a compliant chip for China, the H20. The US government blocks it. Then, after some intense lobbying, they cut a wild deal for a 15% cut of the revenue to allow sales. But then, in a final twist, China's own regulators reportedly told their companies, thanks, but no thanks, over security concerns. So, NVIDIA paused production. The financial hit is real. Their guidance for next quarter assumes 0 sales of the H20 to China, a potential $2 to $5 billion black hole. But the long-term consequence is far more terrifying. In trying to slow China down, the US government's erratic policies have forced Chinese tech giants like Baidu and ByteDance to go all in on a domestic alternative, Huawei. The US thought it was kneecapping a rival, but it may have just forced them into a permanent training montage, Rocky style. They've accelerated the creation of a self-sufficient, state-sponsored Chinese AI ecosystem, complete with its own hardware and its own version of CUDA. In the long run, America may have traded a short-term disruption for the permanent loss of the world's largest tech market. Then there's the second front, the direct competition. This is where it gets interesting. It's not just one enemy, it's 2 different kinds. Enemy number 1, the direct competitor, AMD. AMD's MI300X chip is genuinely competitive with NVIDIA's last-gen H100. Their strategy is classic. Offer a good enough alternative that's cheaper and based on open source software. They are the Pepsi to NVIDIA's Coke. But they remain miles behind on the all-important software front. Enemy number 2, the internal competitor, the hyperscalers. This is the real long-term structural threat. NVIDIA's biggest customers, Microsoft, Meta, Amazon, Google, are collectively responsible for about half of their data center revenue. And every single one of them is spending billions to design their own custom AI chips, or ASICs. Google has its TPU, Amazon has Trainium, Meta has MTIA. Right now, they still buy the best from NVIDIA for the cutting edge stuff. But their long-term strategy is to rely less and less on Jensen Huang. It's a fundamental conflict of interest. It's like selling state-of-the-art weapons to the very countries you know you might have to face on the battlefield one day. As their custom chips get better, more of their internal workloads will shift away from NVIDIA. This is, without a doubt, the single biggest threat to NVIDIA's long-term growth narrative. So, we've broken it all down. The slowing growth, the margin pressures, the China mess, the rising competition, but also the insane demand, the genius roadmap, and the unbreakable CUDA moat. What does an investor do with all this? First, let's talk valuation. With a forward P/E ratio around 44 for this fiscal year, it's expensive. You're paying a premium for a penthouse apartment, not a starter home. It better have a great view. There is zero room for error, as this quarter's stock reaction proved. Now, about that $60 billion stock buyback. Don't get it twisted. On one hand, it's a massive vote of confidence from management, but it's also a clever financial tool. As revenue growth inevitably slows, it gets harder to grow earnings per share. A buyback systematically reduces the number of shares, which mathematically juices the EPS number. It's management putting a giant thumb on the scale. It also acts as a safety net, a soft floor under the stock price during volatile periods. It's both a financial instrument and a psychological one. So, what's the play? Look, this is not financial advice, but here's how to think about it. For the long-term believer, the core thesis holds. The CUDA moat is real, but going all in at these prices is a high-risk bet. A strategy of dollar cost averaging or buying on significant dips of 5 to 10% seems far more prudent. For the more active trader, you have to embrace the volatility. The easy, straight line up money has been made. The path forward will be choppy. This might be a stock where you maintain a core long position, but use options to play the swings or hedge your bets. A core and explore strategy could also work. Hold NVIDIA as your core AI play, but use a satellite position to bet on potential competitors like AMD. So, what's the final verdict on this quarter? It was a tactical victory on paper, but felt like a strategic draw in a market that demands accelerating dominance. The report confirmed NVIDIA's leadership, but it also validated every single fear the bears have been whispering about: growth normalization, margin pressure, and the twin threats of geopolitics and competition. The bottom line is this: the party isn't over for NVIDIA, but the lights have come on and the music has changed from a rave to a chess match. NVIDIA is successfully navigating the transition from a hyper-growth phase driven by pure scarcity to a new phase defined by strategic competition and market maturity. The story is no longer a simple one of how many chips can you make. It's now a complex, multi-layered game of execution, diplomacy, and moat defense. For investors, this means the easy money has been made. The next phase of this journey will still be defined by growth, but it will be accompanied by much higher volatility and a need for a much more critical, nuanced analysis. The next chapter will reward the diligent, not just the dreamers. What do you guys think? Is this a sign of the top, or just a bump in the road on the way to a $10 trillion market cap? Let me know your thoughts down in the comments. And if you got any value out of this deep dive, do me a solid and hit that like and subscribe button. It helps the channel a ton. Until next time.